Hello, this is Jordan, and this is your Precious Metals video market update. This is being recorded on Wednesday afternoon, April 20th, 2016. And starting off, in this chart, I show the entire precious metals complex with the 400-day moving average in each chart. Now, as you guys know, I'm very big on the 400-day moving average, which in weekly terms, it's the 80-week and then 20-month. So very significant moving average, whether you're looking at daily, weekly, or monthly charts. But again, daily chart here, 400-day moving average, GDX at the top, or excuse me, GDXJ at the top, followed by GDX. Then we have gold, then we have silver at the bottom. And look at how the 400-day moving average has done an excellent job of defining the primary trend for the entire precious metals complex. It doesn't matter if you're looking at the metals or the stocks. It's done a really good job of clarifying bull or bear market. And obviously, I highlight the miners. I mean, they've gone above that in recent months. And they consolidated for a little bit in March and then popped higher in the last couple weeks. So it's pretty clear what's happened. The metals have not quite been as strong. Gold has consolidated. A reason for that is the run-up in speculative long positions. Whereas silver, last week, I should note, it broke above its 80-week moving average for the first time since late 2012. So very significant move in silver that I think really confirms what's going on in the entire complex. So the new bull market is on track. But let's get to the very short term. And today we saw a bearish reversal in the miners. We have GDXJ at the top, GDX at the bottom. These are daily candle charts with the 50-day moving average. And I should note that this bearish reversal candle, we saw this in February once and then twice in March, and it really didn't matter. It wasn't as bearish as it should have been. And when you see this kind of a bearish candle, the fact is if the trend is down and you get this candle after a rebound, then it's very bearish. But if the trend is up, it's not quite as bearish. So you have to make that distinction of where the overall broader trend is. And so that could be why that the previous times we've had this candle, it didn't lead to a more significant decline. And so I think that's going to be the case this time around. Although the miners are a little bit overbought, they're still well above their 50-day moving averages. So it is possible they could correct for more than just a few days, maybe a week or two. And one thing I should note, when you're early in a new bull market and the trend is very strong and the corrections are very swift and limited in general, the 50-day moving average tends to be the support you should focus on. And so we can see, let's look at GDXJ, which has been stronger. I mean, that nearly reached 36 today, closed below 34, 33.68. The 50-day moving average is at 27.54. So there's some good distance there, and the 50-day moving average is rising. But I would say, I mean, looking at the support for GDXJ and GDX, I mean, there's two levels of support, which I've drawn with the lines, and then you have the 50-day moving averages, which if this weakness lasts beyond a week, you would probably get a confluence of strong support around 29 GDXJ and then about 20.5 GDX. And by confluence, I mean you have the strong level there, and then you have the 50-day moving average, which is rising, reaching that level. So keep an eye on those areas. I have a couple notes here on sentiment, but I'll save that for the next slide. And here we're talking about the weekly charts. And it's a bit presumptuous to look at the weekly charts before the end of the week. I mean, yesterday the weekly charts looked really bullish. It was clear we had a big breakout in the complex, a GDXJ above 32.33, and then GDX was also above 22 to 22.5. But given the reversal, there's a little question. I mean, what's going to happen the rest of the week? And so if we get more selling to end the week, and if we see the miners close below the lower red line, that would mark a bearish weekly reversal. And in that case, you would probably see the miners come down and test those blue lines. which are basically right at the confluence target that I mentioned in the last slide. So that's something to keep in mind. So, I mean, if this is just going to be a quick correction, you'll probably see the miners close the week around these levels or a little bit stronger. But if we're going to see weakness for more than a week, a sign of that would be a negative close for this current week. But anyway, talking about sentiment, a couple things I want to mention. A couple days ago on sentimenttrader.com, they noted that there was huge outflows out of the miners, GDX especially, which is much bigger. And, I'm not really sure if that's bullish or bearish. I mean, it depends on so many factors. But the fact that there's huge outflows from GDX in recent weeks, and it's been rising, I mean, that's bullish to me because a lot of money is leaving the market, yet it's still going up. Now, maybe that means a correction, a bigger correction is going to come. I don't know. But in addition, 2 months ago, on February 19th, sentiment on StockTwits for GDX was 19% bears and 81% bulls. That 19% bears yesterday was 52% bears. So more people have gotten bearish, even as the miners have gone up, have gone to higher prices. That's very rare. Now, I don't know how actionable that sentiment is. I mean, it could just be an anecdotal thing. We don't know how effective that is. But anecdotally, there's so many people in recent weeks who have just been saying the miners are going to correct. There has to be a correction. Look at the COT. There's a head and shoulders in gold. I mean, there's this, there's that. They've gone up too much. And it just seems to me that everybody has been on the sidelines waiting for a correction. I mean, I even remember myself at times in February and even a couple weeks ago, I said it might correct a little bit. And back in February, it started moving. And I said, oh, it's wait for a correction. And, every time it would correct for 1 or 2 days and it would just go back up. And so we've seen that's continued to happen in the last couple months. And this is what happens after really, really bad bear markets, is that the new bull market, the rebound, it happens and it's met with so much skepticism. Or if you're not skeptical, you think, well, there's going to be a big correction and then I'll buy in. And then it just keeps going higher, because if you look at the gold stocks, they're emerging from the worst bear market in 90 years. When they were at their low, it was I have to look at the ratio charts, but you look at that 6-month base there at the last half of last year, the gold stocks relative to gold were basically the lowest they'd been in probably 90 years. Gold stocks relative to the stock market were the lowest they've been in 90 years. So I'm preaching a little bit here, but the bottom is in. We're in a new bull market, and the risk is being out of the market. Now, that might not be the risk for the next week or two, but the larger risk is that you're out of the market, you're waiting for some big correction, and we will have a big correction at some point. But the fact is, the bigger risk is being out of the market. And if you look at the fundamentals of gold stocks, they improved last year. I mean, oil has collapsed, so it's much cheaper for most miners to mine because oil is 30% of the cost. You look at if you're running mines in Australia, Canada, or parts of Africa, the local currencies there are so much lower than they were several years ago that your labor costs have gone down significantly. So look, you put all these factors together, the major trend is turned, and we're going to continue to move higher in the months and quarters ahead. Now, that doesn't mean we're going to move higher over the next week or two, but we'll see what happens. I'm just saying, remember the big picture. Now, moving on to gold, as I said, a lot of people have pointed out this phantom head and shoulders pattern, and also, they've been worshiping the COT. Basically, the way a lot of people look at the COT, it's like as if that's the number one indicator, and the commercials are always right, and the commercials are smart money. That's not the case. They're not smart money. They're not always right. I mean, the commercials, what they generally do is when the market goes down, they get more bullish. When it goes up, they get more bearish. So, that's something you really need to keep in mind. And I've showed charts in the past. If you go back 10, 15 years, there's been many times where the trend looked extended based on the COT, and then the trend just kept moving up. It's happened in both directions. So be very careful worshiping at the altar of conventional COT analysis. And but what I have said in recent weeks is, look, the fact that silver is showing strength, the fact that the miners have been showing a lot of relative strength, That's a good sign for the sector. That's telling you that gold is not going to have a big move lower. But because there's a lot of spec money in gold right now, it's been consolidating, and that's been my view the last couple of weeks, is that gold, if it's not going to break out, it's probably, because of the COT, it's probably going to continue to consolidate. And so we see it's stuck in this range. Now, what gold needs to do, it needs a weekly close above 1260, and it also needs a monthly close above 1262, which is the 40-month moving average. That's very, very significant. So, you know, again, I don't know if it's going to happen this week, next month, or in a couple months, but just be on alert for that. If the miners, when they start moving higher again, whether it happens in a day, a week, or a month, that could be a signal that gold is going to break above this resistance and perhaps ultimately rise to 1400 in the next several months. But from where we are now, there's a lot of spec money in gold. Some of it needs to come out, not a lot, but just some of it. And so it's possible gold could come down and test 1210 again. But the weakness in gold right now is very similar to what happened at the start of the bull market in 2001 and then into 2002. The miners had a huge move higher. I mean, they had a massive move higher before gold even went to a new one-year high and broke above the previous high, which would be 1308 in this instance. If you're waiting for gold to break above 1308, I mean, the miners could be 50% higher before that happens. So I know I'm preaching a little bit, but just keep all these things in mind. If you have not already, you can get my book at thedailygold.com/book. Thanks everybody for listening and watching, and I hope you found this informative, and I wish you all the best, and I will have another video update for you guys in the next week or two. Thanks again.